Okay, guys, so I'm here again on the market structure and to clear out the confusion based on how most traders look at the market and how they do the analysis. So I'll start from the basic again by drawing out our structures of higher high, higher low, higher high, higher low, higher high. Then you could eventually have a failed high, then the market shifted at this point, right? Now, with the idea of understanding institutional concepts, the smart money concept, and understanding how the market operates, we do know that every high has buy stops, right? So what does that mean? It means that we are having liquidity resting above the high, right? So if we have buy stops on every high, then we are having sell stops on every low, right? So we have uh, sell stops and we have the buy stops. Now the market has been bullish, right? These buy stops you're seeing here means that um, a sell was placed at this particular point to pull the market back down as a retracement because we have an expansion, then this right here is a retracement, right? So we have expansion, we now have retracement, expansion, retracement. Now the market bought at this area, short was placed right here, which pushed the market lower as a retracement, right? So it means that there are stop losses resting on this high that was protected for a pullback, right? Now, based on the market is on the bullish structure, the essence of this retracement is to close every buy orders that was activated here on break even, and then the market continues again, right? Then short was placed here, they sell off some little portion, and then they buy again. So that is why they say that everything about the market is buy to sell, right? And buy and sell. The sell to buy, the sell to buy, the sell to buy, right? Now, one mistake most traders do is that okay, now if we are in a bullish structure, it means that every sell stops will be protected, right? Because we are in a bullish structure, so that means that every buy stops will be taken out. Every stop loss is resting on every high, they all will be taken out, and every stop losses resting on every low will be protected. So we are having an area of demand in that area, or an order block or fair value gap on that area to continue pushing the price higher until the market decides to change its direction. Now, here is the mistake that most traders do in their market. Now, you saw that the market shifted its direction right here, right? We have a change in character or a break market structure, right? We have a break market structure right here, and everything that occurred at this area is a break of structure, right? The continuation is a break of structure, and then the change in trend is a break of the market structure, right? Now it changed direction right here. The buy occurred at this area, so we are expecting to say that since the market is bullish, we should be buying at this area. Now it bought to that area, it was expected to trade higher, right? To continue the bullish structure. But then what actually happened? What actually happened? What actually happened is that we have a failed high resting on this area. A failed high occurred. It failed to take out a high. Alright? So we are having a failed high. So the failed high also led to a shift in market structure. So we're having SMS, we're having a shift in market structure because the market shifted right here. But you won't confirm this failed high and the shift in market structure unless it breaks the demand and it changed the direction. It changed direction, like it took out a low, a higher low. So we're not having a break in market structure. So it is confirmed that we're having this failed high and we're having SMS, a shift in market structure like this. Okay. Now the mistake that most traders do is that this demand failed. Most traders will still want to buy at this demand also, and every other demand that they are seeing here, because they have the mindset that that is an order block and it has to continue being bullish, right? Like they say, oh, we have an unmitigated order block, it has to continue being bullish. But no, that is the mistake you're making. That is why you always fail. All right. Now here is what you should understand. Remember, I say that stop losses are resting on every high and on every low. Buy stop and sell stop. Sell stop protected in a bullish structure. Now the market changed direction. What is it doing? It is now coming back for the stop losses, the stops that it left behind, the liquidity that it left behind. That is what it is coming to take. Right now, what are those liquidity that it left behind? Sell stops. Right there. So if it shifted direction right here and break a structure, taking out this sell stop resting on this low, what will be its target? Its target will be to continue taking every sell stop that it left behind. So every area of demand that you're trying to look at will not hold because the market changed direction from bullish to bearish. So why would you still be looking for another block to buy from when you already see that it has changed direction to protect buy stops and to start taking out all the sell stop that it left behind together with the sell stop on every lower low. So it's grabbing liquidity on this lower low and this higher lows. Alright, it's shifted direction. That is what you should understand. So don't try to buy at any demand you're seeing. There are now liquidity because the market changed direction and it is now doing what? Selling from a bearish order block or an area of supply. So why would you be buying at this demand if you know the price is coming from a supply zone? And why would you be buying when you know the market has changed direction from bullish to bearish and grabbing liquidity of every sell stops that it left behind? Why would you be doing that? That is your mistake. That is what you should understand. Alright? Understand your structure, and you should understand liquidity, that every highs and lows has liquidity. If the market has to be bullish, it is protecting the liquidity. It left the sell stop behind to come back for it later. That is why liquidity has to be present in the market. It has to. Now, that is it for that. And also, another structure is you're having higher high, higher low, higher high, higher low. Then you have a stop hunt, and then they break in the market structure. Now remember, you all know what stop hunt means. It is just a weak trading higher that did not actually break a structure because the candle stay closed below this high. So it is a stop hunt. You just grab the liquidity, and you only confirm a stop hunt if it has to break the market structure of that major low from the high that it grabbed liquidity from. So stop hunt plus breaking market structure, taking out this demand, right? So that means your demand is not likely to hold, and every other demand you're trying to buy from will not work out. Sorry, I have a printing machine, 3D printing machine right here, so it's at work. So sorry for the noise. Sorry for the noise. The trip is just printing something. So yeah, that by the way. So you should understand your structure. You should understand everything you have told you here, and you should understand liquidity a lot. Buy side, sell side, buy stops, sell stops, right? Change of direction is coming to take liquidity that it left behind. All right, unless maybe it just did a liquidity sweep and it continued the bullish structure. So these are the things you observe where there is liquidity sweep, and when you actually see a break of structure. So you will confirm to sell this market, and you will confirm that the market changed from bullish structure to a bearish structure. So sorry for my MT5 noise, so I'll just delete that. So now I will go over to the real chart to show this to you. So right here we are having our DXY, so you can actually see how clean the structure is, right? So I will start marking the structure. So we have high, and then we have low. Now you should observe how I do mark my highs and lows, right? If you observe, I am not going to mark this area as a high, but we say this is my higher high right here, and I mark this as my higher low. Now why would I mark that way? This high, low, high, low. The reason is because there is no break of structure right here. Alright? It just a stop hunt, like a grab liquidity traded lower, and this is where I have a clean high. You can see the expansion from there, right? The areas where I have expansion are the areas where I mark my higher highs and higher lows. So I mark this high, low, low. Then my new high would be this one, or I could just ignore this one and say that the high I would prefer would be this one. Alright, so now you could actually see that the market has been on bullish structure, right, and is leaving sell stops behind, right? Like our sell stop right here, they're all left behind. So we use the curve, like I use curve to represent that. So I'll mark this one, then I'll also mark this low. Okay, then I'll take this low also. So now what did you observe right here on this structure? You observe that the market has been respecting demand and supply. Right here it actually trades into a fair value gap, but those that trade supply and demand will say a last candle right here, but it filled a fair value gap. And also I could see KMTR right here. Right here I have KMTR on the lower time frame. You will see that has a KMTR that was used as a resistance. Why I call it KMTR is that it is a failed KML right here. Alright, because when you see a single break, you think you're seeing a break of structure. No, it's not actually a break of structure. Okay, this is not a structure. I'm not considering this as a structure because I would say this is the low, and it pushed higher to create this high, trade lower, this is the low, right? So you should know how to mark the structure. This is not considered as a structure. So those traders that think this is a break of structure, and we are having a supply right here. There's a KML, but then the KML fell because the market is what? Bullish. So why would you be selling? And remember I said a single break of structure is not a confirmation that the market wants to go bearish. Alright? So KMTR, it traced back to a fair value gap, and it continued higher. Then it comes back again to an area of demand. Then it traded higher again. So the same thing again and again. Now you should observe that we have an unmitigated demand right here, right? I think I posted about DSY and Euro, where I say that if this demand failed, that means we are going bearish on the dollar. So you should observe we have a structural high and we have the structural low. The market traded higher, right? Then this is our new high because this high, low, high. Then we see how we traded lower. This is a low. And what did it mitigate? It mitigated an area where we have a consolidation. So this is an area of demand, a demand flip, because this is a supply that failed. Then we have the demand flip right here. Now it mitigated the demand. It failed to create a new high, right? You should observe that. It failed to create a new high. That's why I always say you should always start your analysis from your higher time frame. Mostly I like to look on the daily chart because it gives me a clear and a clean structure that I want to see. And then Yeah, that is it. Now you should observe that it failed to create a high after indicating the demand right here. So it failed to create a new high, but it is not yet confirmed. It's not yet confirmed. It's only confirmed when we see trade lower and we see it breaking a low, right? So you have a confirmation that you're having a failed high plus a break in market structure on our daily chart. So what we're now having, we're having a shift in structure right here, and after the shift in structure, we now have a break in market structure, right? Now, supply and demand trade with wicks, right? Because it took out previous candle high. So if we go down to lower time frame, we see that it did a stop hunt right there. So it grabbed liquidity, and then we see trade higher. We have a break market structure. It's a clean break. It closed below this low. Then we now see a failed high, right? So while we just still be buying at this area, when you have already seen that it failed to create a new high and a demand has been violated, why would you still wanting to buy at this demand? Why would you still wanting to buy anywhere you can think of, or wanting to buy right here? I will tell you that this will not hold. This will not hold. The reason is because the bearish trend has ended and we are now on the bullish trend has ended and we are now on a bearish market. So now we are seeing that a demand has been violated. So every sell stop, every protected demand, it is now a risk. Okay, they are now liquidity. They are now liquidity, and we can see it grabbing them all. Okay, structure is also liquidity because you could actually tell that since we've been bullish, it's a trend line. Okay, so now the idea right now is that since we're having a breaking market structure, we have a changing character. Now our new supply is now resting here. So if obviously the market might decide to trade higher, we might see it go to that area and we'll be looking for sales entry right there. But right now the market decided not to pull back, and we are still seeing a structure, bearish structure right there, and we can see that we grab liquidity from here. I'm not considering this as a structure, all this right here. I'm not considering that as a structure. So we look at the weekly time frame. So you could actually tell where the market is wanting to go, right? You can see the order block failed right here. So we have sell stop resting on this low. So the dollar we trade to get that low right there, and we still have our supply zone resting here. Okay, and it seems like the market is on a premium pricing, so it needs a pullback, and then we'll have it to come from this low. So you could check all your chart, you actually see it. So let's check on gold, and you will observe the same thing. I already explained gold to you before, and I told you that it will go higher to grab liquidity on this what is it called, buy side liquidity right there. They are relative highs, and I told you that the market has been bullish, right? And I also said what we are seeing here is a range market. It is not a structure. You should take note of that. So below our liquidity, we have our demand right here. Okay, so you should know about that, and you know the market has been bullish. This is our high, low, high range market, top demand, attacking the relative highs that we have here. So gold is still bullish, and now let's go to GBP USD. So you could actually see something right there. So this is GBP USD, and I've already drew this stuff as a sent to my group that I could actually see trade higher. But that aside, let's look at the one I explained before. Yeah. So on GBP USD, we can actually see that the market ranged at this area, then we see it dropped, it ranged again, then it dropped, but then it just grabbed liquidity. Now you do know that this is not a structure, it's not a structure at all, it's just a ranging market right here, and the market's been bearish, right? So if we move over to the 3 months time frame, we could actually see that we are having liquidity void above here. We have an imbalance, so the order flow could be that the market will trade out of this consolidation higher to go to fill the imbalance that we have here, the CB that we have here, and eventually fill this demand, sorry, this supply, and maybe since we have stops resting on this high, we could want to grab liquidity from that high. So it's very easy to understand that. It is very, very easy to understand that. I am not saying that I might be true, it is just the way I just see the market, because this is a range market, and I do know there is nothing I could see here that would say we are selling from, right? So we just see how the market goes, and we can see that from the daily time frame, or let's just say the weekly. No, let's go to the daily time frame. You will see the supply has been violated. You know, we do have a break of structure right here, right? So the idea is that since there's a break of structure right here, we should be selling. But then what happened? Supply was violated, and we have liquidity right there. It just grabbed, it just so lower, grabbed the liquidity, and what did it mitigate? The demand was responsible for violating our supply right here. So it mitigated the demand, and you can actually see it going higher. So what is it targeting? It is targeting buy stops resting on this high. Okay, so that is just the way I see it. Yeah, the way I see it is very simple, and you can see it's actually relative highs resting on that area. So on the 4 hour, I still have this demand resting here, but then price didn't bother to come to that area. So it's been rough. Yeah, I could tell you it's been rough on the market. So I hope you understand what I just explained right here based on the market structure, and how you should actually do your analysis to know where the price should run to, understand the algorithm, you know your highs and lows, you know when the market decides to go from bullish to bearish or from bearish to bullish. So yeah, do not make the mistake of trying to buy when the market is bearish or trying to sell when the market is bullish. It is very, very risky. Okay, so you should actually have your bigger view and understand it from your higher time frame before you even think of running down to the lower time frame. Do not, when you open your chart, do not start your analysis from the lower time frame. Move over to your higher time frame. Okay, then before you could run down to your lower time frame to look for a confirmation entry. If you do not see any, do not execute any trade. Okay, unless you could like be day trading, like I could show you one on Euro USD. You could like day trade, and it's very, very easy. ICT taught that. So we have Euro USD, and I'll show you something right there that I shared. I'll cancel this. So I don't know, this is not the one. So I think Forex.com. Alright, so here it is. You could be trading something like this. It is just simple. It's ICT concept where you have an Asian range, price open. You know we don't trade Asian, right? So let's just say price open, and we are having Asian high right here, and we're having Asian low right here. All right, so we have Asian range high, right? Then this one will be our Asian range low. We have Asian range low right there. So now you should observe, you should not trade during this area. Now if your bias is bearish, you should see something like this happen. During rundown session, we have the London Q zone, and you wait for price to do what? Take out the Asian high. First, take out Asian range low, then Asian range high, then you look for your area of demand. It is a confirmation trade. Then maybe during the New York session or the same London, you have a pullback in area of demand or the block fair value gap. Then you go day trade to take profit on that high. this high right here. Now, if something like this occurs, Asian low was taken out, then it's fair to take Asian high also. Do not take the trade, okay? Because if you say Asian low was taken out and you're saying you want to buy from here, it will just take you out, alright? You have to wait for the two sides to be taken out. Asian low first, Asian high, then you buy, take profit. But if Asian high was taken first before Asian low, then you know you're having a sell bias. But then follow the higher time frame, okay? So this is what we have right here. We know the market be bullish on Euro USD. So right here I have the Asian range high, Asian range low, market traded lower. We have a change in character, and then the Asian range high was taken out, so it is a break of structure. Two sides has been taken out. Then we see a fair value gap. Alright, so I will mark this as a fair value gap right here, and I'll mark here also. But then we do have an order block resting right here. So that is our order block. Price traded lower, fill the imbalance, mitigated the order block, and we see trade higher. Now you can see that on the 50-minute also. Right there, you can see, if I refine, this is our demand zone right here, and it filled a fair value gap. And if I go lower time frame again, you can see our 5 minutes time frame, the main zone resting here. So you can see how the market take out Asian range high, range low first, then the high, then pull back. You can see it's trade higher, and that is a cool profit. Like, it's a cool profit. So I'll show you on your indicator, Asian range. You click on that, it should appear. So I will change the color so you should see it clearly. Let me make it blue, then visibility, no, okay, yeah. So these are our Asian range high, then we have our Asian range low. Market continue to trade lower. I think it mitigated an area of demand from daily time frame that violated an area of supply right here. So you see it trade lower, take the Asian range low first. Then let's see if what we have is in London. So we have London New York session right there. So I click on the London New York session. Then I have my settings. London set on this color. So New York set on this color and increase this. London, I increase this also. So you could actually see it right there. Sorry, I don't like all this color. Now we have the Asian range occurred here, right? Now it trade out of the Asian. Then we have London happen here. Price traded lower, taking Asian range low. Then this is where when I have the lapping of London and New York, you can see how it possibly trade higher, right? The New York and it traded lower after taking Asian range highs and changing breaking structure lower. It traded lower to the demand, and we see slightly higher, right? Now when I talk about the highs and lows not taken out, you can see Asian range, but nothing happened right here. It just continued, so you should avoid that. The same thing occurred right here. Asian high will be taken out. There is no break, there is no hunt, and there is no break structure. So let's continue to look if we see another example. All right, so here is another example right here. We have Asia range high right here. Then we see our Asia range low, traded lower right here, right? Now it came into London, right? London took out the Asia range high and continued higher, right? So let's move this to 15 minutes so that we could actually see what happened right there. All right, so on the 15 minutes we see Asian range low taken out first, and we entered into London we now see a stop hunt right there, plus a what? Break in market structure. But this one is just a stop hunt, so it traded lower, and we now finally have that break in market structure, taking out Asian high and taking out buy stops resting on this high. So what would you expect? Put on London. During the lapping on the London, we can actually see it trade lower to our order block right here. Right, area of demand order block, taking out what? Inducement. You can see it created inducement right here. So there's liquidity that it has to grab. So it's a confirmation trade. Tap, rally, you take your profit on this high. Okay, so market traded lower and closed on Asian. So you just have, you could just be day trading that same way. So same thing happened here, but it seems that the price did not trade back that day. So it's fine with that, it's okay. So if you could just the day trading is fine, you could actually stay in the market. So right here the market has been ranging, so this is not something you should get yourself involved. Do not trade a range market, okay? So I am taking all of this off. My eye is being affected by it. So yeah, I hope you guys understand this, and yeah, I hope it helps a lot. So take care.